Welcome to the College Investor Audio Show, where we talk about the biggest issues impacting millennial money, from student loan debt to side hustles to building wealth. We will show you how to get out of debt so that you can build real wealth for the future.
Welcome to the show. We are so glad you're here as we attempt to answer this question. Is there such a thing as a guaranteed rate of return? We live in a world of unprecedented consumer guarantees. When you buy a t-shirt online, you expect to be able to return the shirt if it doesn't suit you. If your pineapple from Aldi turns out to be rotten, you can go get your money back and get a new pineapple for free. We're used to guarantees that protect us from all kinds of minor financial setbacks, but unfortunately, the expectation for guarantees could lead you astray as you consider your investment strategy. If you expect guaranteed investment returns, you could end up underperforming or even buying terrible financial products. So here's what you need to know about guarantees when it comes to your investments. First of all, what's a guaranteed return on investment? Well, this is the fixed rate of return that you can count on with absolute certainty when you invest in a particular product. Most investment products involve risk. It's rare to find an investment product that will certainly go up over time. For a long time, investors believed that real estate would never fall in value. But the housing market crash of 08-09 disabused investors of that notion. Real estate doesn't offer guaranteed returns year after year. Stocks are another investment that has a high degree of volatility. The stock market isn't a high-yield savings account. One year, stocks will be up 25%. Another year, they will be down 36%. Overall, stocks do tend to have higher rates of return over the long term, but stock returns just aren't guaranteed. For the most part, bonds offer lower returns in exchange for lower volatility. When you take out a bond, the borrower is guaranteeing that they will pay a set interest rate in exchange for borrowing your money. However, bonds typically don't offer guarantees. Businesses and governments that borrow your money may default on their loans. That could mean that you lose money. Legit types of guaranteed return on investment. All right, so most investments, even safe investments, don't really offer a guaranteed return on that investment. Finding a legitimate guaranteed return on investment is very rare, but there are a few legitimate investment products that do offer a guaranteed return. These include I-bonds. Issued by the United States Treasury Department, I-bonds offer a fixed rate of return for 6 months at a time. The rate of return just depends on the inflation rate in the U.S. economy. That's it. I-bonds are designed to earn a guaranteed return that matches the inflation rate in the U.S. economy. These bonds became incredibly popular in 2022 and early 2023 when inflation neared double digits for the first time in 50 years. It's not often that you find a guaranteed return on investment that's nearly 7%. TIPS. These are Treasury inflation-protected securities, TIPS. They are also issued by the United States Treasury Department and also indexed to inflation, making them a great short-term investment. However, this investment is slightly different than an I-bond. TIPS receive adjustments to their principal value plus interest payments every 6 months. So your principal value will never shrink below your initial investment, and you get to keep the interest income you earn every 6 months. TIPS have a guaranteed floor of 0% with an upside potential that matches inflation in the economy. CDs, or certificates of deposits, are bank-issued investments with guaranteed interest that is paid every month. Your yield can be locked in for periods ranging from 6 months to even 5 years or even more. Unlike most investments, though, CDs are FDIC insured. That means if a bank fails, you're going to get your money back, including the value of interest that you accrued before the bank failed. A lot of retirees use CD ladders to earn interest while also keeping their near-term retirement funds in a relatively liquid investment. Annuities. Annuities offer a lifetime income option for investors who want a guaranteed stream of income for their entire life. Annuities are a bit like personal pensions that allow investors to convert a portion of their investment portfolio into an investment with lower returns that are guaranteed. Before buying an annuity, though, talk with a certified financial planner and investigate all the fees. you might end up paying excessive fees in exchange for the guaranteed return, which doesn't make it a return at all. Anyway, let's move on to where you should be skeptical of a guaranteed return. A lot of investment salespeople, including many who call themselves financial advisors, use aggressive marketing techniques to get you to believe that they are offering a product with unique guaranteed returns. The worst offenders in this category are whole life insurance products. Whole life insurance products build up cash value over time as you make premium payments. The cash value in the account never goes down, and in some conditions it actually goes up. Therefore, whole life products offer a guaranteed rate of return of at least 0%. If a guaranteed 0% rate of return sounds bad, it should. But the marketers behind compound interest accounts and other related whole life insurance products do a lot of complex math to make you believe that the guarantee is better than it really is. If you need life insurance, buy term life insurance. Then find investments that will help you maximize your long-term returns. But the other place we've seen guaranteed return language relates to online loans. Agricultural loans, real estate loans, and other crowdfunding business loans do not offer guarantees. The borrowing company could go out of business or fail to make timely payments. Even a company that has always paid its investors may fail to make a payment during a cash crunch. Lending money to a company always includes risk. Don't believe the slippery language that makes the return more guaranteed than it really is. Are guaranteed investments better than other investments? It's a great question we get all the time, but all things held equal, including the returns on investment, it's really better to choose an investment with a guaranteed return than one without a guarantee. But most investments that have guaranteed returns don't offer returns that beat out inflation. So to grow wealth in the long term, you need your money to work harder for you than inflation can work against you. That means investing in some riskier assets. Diversifying your asset allocation can help protect you against downturns, but even a diversified portfolio can go down during tough market conditions. So if you go ahead and just expect up years and down years, you may be prepared to stick with your investment plan even during those down years. But by remaining invested during a downturn and even buying more during the down market, you are likely to become a very successful investor over many decades. Those who panic during downturns and move everything to guaranteed investments are likely to lose money to inflation over the long term. So keep those things in mind. As we wrap up our show for today, you can check out thecollegeinvestor.com if you want to dive very deep on different types of investments and different things you can do to grow your money. We just want to help you out. You can also, if you have any questions or concerns or anything you want to add, follow us. We're all over social media. Just check us out at The College Investor. Thanks so much, and we'll talk to you again real soon.